Good evening, everyone. I, C. Nehal Gadda, on behalf of the Women and Young Members Excellence Committee of ICAI, extend a warm welcome to you, all of you, to the Sky High Symposium series. This committee is chaired by CA Preeti Savla and Vice Chairperson CA Abhay Chhaje. The Sky High Symposium series, held every Wednesday, is a platform created by the committee to share technical updates, enhance non-technical skills, and encourage our members to confidently express themselves in public forums. This initiative aims to empower and inspire our members to step forward and make the most of their abilities. Chairperson CA Preeti Savla is the chairperson of Sustainability Reporting Standards Board and also the vice chairperson of Valuation Standards Board for the year 23-24. Vice Chairman CA Abhay Chhaje is also the chairman of Commercial Laws Economic Advisory and NPO Cooperative and also the vice chairman of Accounting Standards Board. Today, we are here to learn and listen on the recent issues in withholding tax on foreign remittances. Foreign remittances have been a part of our daily life, be it tours abroad, sending gifts to relatives and friends living abroad, buying stocks in foreign markets, and purchasing property in foreign countries. So I take this opportunity to introduce our first prolific speaker, C. Nilesh Karya, who is a true authority in this field and graces us with his insights on the topic of the day. C. Nilesh Karya is a member of the Institute of Chartered Accountants of India and has a bachelor's degree in law and commerce from Mumbai University. He has 10 years of professional experience in the area of direct and indirect taxes and was a part of tax and regulatory service team of Desai Haribhakti and Company for 5 years. Currently, he is working as an executive director of tax and regulatory services at RKJS and Company LLP Chartered Accountants. Our speaker today is a delivery expert in advising tax implication on transactions, litigation under income tax and indirect tax law, cross-border transaction, related advisory and structuring of the same. With this brief introduction, I welcome CA Nilesh Karya to share his insights with us.
Thank you, Nehal. Good evening, everyone. So I share my presentation. Yeah, is it visible? So today's speak. I thank you first of all, WIMEC, for inviting me to speak on recent issues on withholding tax on foreign remittances under Income Tax Act. So uh, the topic itself is wide enough, and we right away start with the today's. I'll be speaking on overview of the TDS under income tax as well as TDS on foreign remittances. Then we will also covering double tax avoidance and its disputes, and some are the latest amendment with respect to the TCS as well as the foreign remittance regarding issuing 15 CB, 15 CA. Then what are the controversies and what are the views upheld by the courts in some of the cases, and the what are the open issues where the litigation is still pending, and how it will react in the future. Okay, so let's begin with the overview. I would like to tell what is basically a TDS. TDS is a type of mechanism under which a person liable to make a payment to any other person will deduct income tax on it and transfer the balance amount to the other person. So this particular responsibility have been casted by the Income Tax Act. However, the primary responsibility to collect tax is of a tax administration. So this is basically a delegated responsibility which has been casted on the taxpayers. Of late, the importance of the TDS have increased very much, and it by bringing a lot of amendments into the act, most of the transactions have come in the ambit of the TDS provisions. So, if you see, previously there were only 4 or 5 type of transaction which were under the TDS provisions. However, during I think starting from 2018-19, they started bringing a lot of transaction into the ambit of the TDS provisions. Some of the transactions are even not even the income. Still, those transactions been uh, have been brought to the TDS provision. Those transactions are like cash withdrawals. Own cash withdrawals uh, ca- have been brought into the TDS provision. Some of the transactions like LRS, you transfer a foreign remittance under LRS scheme, still TCS needs to be deducted or collected by a person. And few other transactions like e-commerce operator, online games, virtual digital assets have also come into the TDS ambit. So over the period, significance of the TDS have increased, and a lot of transactions have been brought under the TDS provisions, and many circulars have been issued to clarify the position of law, and some of the FAQs also been issued to clarify the TDS provisions. So, compliance for a TDS provisions are fully technology driven. So previously, in maybe 2005 to 2010 period, TDS certificates were issued manually. Now TDS certificates are fully online. There are certain applications which you can directly make online, like lower withholding tax application, which you can make online directly. TDS returns are online, TDS payments are online, 15 CACB is also online. Even recently, Form 10F declaration under Form 10F is also made mandatory online. So while compliance have been fully driven technology based, so there are other side effects also, like department can track your activity very quickly. They can send a notice very quickly for any non-compliances, or even smallest of smallest non-payment of TDS. They send you direct notice on your email or on your phone. So there are side effects of this quick automated technology driven process. So these provisions are needs to be complied by the taxpayer. If you do not comply, there will be a penal prosecutions. So if you do not deduct TDS, then there will be a disallowance under your corporate tax return. There will be interest for non-payment or short payment, or or you can say non-filing of TDS return. There will be a penalty levied, and in some of the cases, prosecution also been initiated by the income tax department. So of late, TDS department have started issuing TDS prosecution notice to the delinquents accounts, like if a person is consistently not paying TDS, or he is a willful defaulter of a TDS provisions, he is a assessee in default willfully, then department are sending notices for prosecutions. uh, there are instruction to officers for going for a prosecution. Limits, internal circulars are there. Limits have been specified at 25,000. If you are delaying for more than a month or 2 months, still you are getting a notice for a prosecution, which is very draconian provisions, you can say, which is very stringent. Or maybe if you have defaulted continuous period of 2 months or 3 months, still you will be getting prosecution notice. To justify this, very difficult to justify. So let's dive into the presentation of today's topic, TDS on foreign remittances. So under the Income Tax Act, Section 195 is the only section which covers the foreign remittances, TDS on foreign remittances. Whereas for domestic supplies, there are quite many TDS provisions. However, the main important factor under 195 is that 195 talks about any person responsible for paying to a non-resident any sum chargeable to tax under this provision of the Act. So it's here the relevance of the provision is taxability of the payment. Whereas if you see under domestic supplies, there is no relevance of taxability or chargeability of the payment. So this particular issue have been discussed and upheld very thoroughly in GE Technology Center Private Limited case, wherein the Karnataka High Court has dealt with this particular issue, which says under section 195, the relevance of taxability has been specified, whereas other section does not specify the relevance of the taxability of the payment. So if it is specifically provided, then if income is not taxable under the Income Tax Act, then no TDS has to be deducted. So when I was talking about the importance, you can very well see from the numbers which has been contributed by way of TDS collection. Year on year, it has increased about 45% from financial year 21-22 to financial year 22-23. So when we go in the scope of section 195, it is mainly relevant to the taxability of the income under the Income Tax Act. Further, what is the point of taxation, payment or credit, whichever is earlier? What is the nature of transaction? It purely depends on the payment. What is the nature? Either it is royalty, FTS, interest, dividend, etc. Rate of tax will depend on the nature of transaction. So TDS on foreign remittance is fully in the ambit of the section 195 only. Moving on, we shall discuss the DTAA, double tax avoidance agreement. Double tax avoidance agreement is basically agreement entered by two central governments of two different states. This agreement, where both parties are required to allow relief by a foreign tax credit or exemption method under bilateral agreement. Thus, it ensures no individual pays income tax twice on the same income while working for a foreign company or maybe Indian company. So where DTAA entered between contracting state and other contracting state to provide relief with respect to income taxed in both the states, provision of this act shall apply to the extent of beneficial to the assessee. So section 92 provides for the this particular provisions, which says if tax rate under IT Act is less than the tax rate under DTAA, then IT Act would be preferred, or whichever beneficial rate is preferred to be applied to the assessee. Okay. So during the last budget, Finance Act 2023, there was very important amendment has been brought to income tax. So up till 31st March 2023, tax rate for the royalty and FTS was 10% plus surcharge plus cess. And if you pay 10% plus surcharge plus cess on royalty or FTS, then non-resident would not require to file a return in India. However, come 1st April 2023, this rate has been doubled by 20%, and plus such as plus cess. And if you were to take a benefit of the treaty, then non-resident would require to file a return in income tax under Indian income tax. So by doing this, they have basically enlarged the scope of filing an income tax return. So generally under double tax avoidance agreement, rate for royalty or FTS is 10%, 15%, or payment would not even be subject to tax. So what has happened, if you want to give a treaty benefit at a lower or nil rate, as a payer will need to examine whether the transaction on a certain criteria, whether person is eligible for accessing a treaty by way of tax residency, or you may also test for a principal purpose test, ownership based test, or whether person, LLP or individual, or maybe pass through entity, whether they are eligible to access a treaty. Because in certain cases, partnership, LLPs, or pass through entities have questioned by itself whether they are eligible to access a treaty. So doing this uh, for a payer, whole Pandora box have been opened with a lot of obligations while making a payment and accessing a treaty. So while making a payment to a non-resident, if a payer has to ascertain whether person is eligible to access a treaty, what he would see? He would ask for a tax residency certificate, maybe declaration in Form 10F, and further declaration no PE certificate, no PE declaration, whether that non-resident supplier has a PE in India or not. So, and further, if you default in complying such provisions, then there are penal consequences which we have discussed earlier. So by doing this, the payer will have lot of obligations, and he may also have a onus to prove that what income tax rate he has deducted on foreign remittance, he would have to prove by writing to the income tax when he receives a notice. Then we move on to the eligibility criteria for accessing a treaty, which we also discussed. Then characterization or nature of payment. So this for this particular thing we will be discussing in full length in the subsequent slide. However, there are characterization and nature of payment are like royalties, fees for technical service, like business profits, also interest, dividend. So these are the these are the nature of payment which are covered under Income Tax Act as well as double tax avoidance agreement separately. What are the documents to be obtained while making payment to the non-resident for verifying whether he's eligible to access a treaty or not? If he is not eligible to access a treaty, then whether the income tax is liable to be paid under Income Tax Act or not. So certain documents are specified under 94 or 95. So then what are the payers compliances? So he will have to obtain a 15 CV certificate from a chartered accountant. If the payment is not taxable, he may file a Form 15 CA Part D directly without obtaining Form 15 CB. Then there are certain payees compliance, like if he is eligible to access a treaty, he may have to obtain a PAN, need to provide a tax residency certificate, file Form 10F online. As with effect from 1st October, it has made mandatory even when your income is not taxable in India, still you will have to file online Form 10F. When you access a treaty or you take a benefit of treaty, you will have to file a return income tax return in India. So these are all main key dispute under DTAA would be nature of payment, applicability of rates, applicability of treaty, whether it is accessible or not. These are the key disputes under the double tax avoidance agreement. So we move on to the latest amendments. So with effect from 1st October, these two amendments have been applicable, have made it applicable. So amendment with respect to tax collection at source under 206C. So basically, previously, if your payment is if payment is made for a tour operator, a tour package, overseas tour package, the rates in force was a 5%. Now it has increased to 20% if your tour package excess of 7 lakhs rupees. Then for education loan taken from financial institution, there is no change. Previously, it was 0.5% in excess of 7 lakhs. Still, it stands at 0.5% in excess of 7 lakhs. TCS on remittance under LRS for the purpose of education other than above or for the purpose of medical treatment. If you are making a payment to your cousin, brother, or cousin, then if it is in excess of 7 lakhs, it would be a 5% in 5% rate. There is no change. TCS on any other LRS payment in excess of 5% from 5% in excess of 7 lakhs from 5% to 20% has increased. Then, as I said earlier, Form 10F to be filed online mandatorily with effect from 1st October, even when the non-resident does not require to obtain PAN as per the relevant provision of the income tax. So this is very, very important amendment, or maybe for a non-resident perspective. If a non-resident is accessing a treaty and if he is required to obtain a PAN for filing declaration in Form 10F, then it would be very difficult for a non-resident to file income tax in India, or maybe a burdensome for a non-resident to file an income tax in India without even having any income, without even having any permanent establishment in India. This Form 10F has been made mandatory online. I don't know how it has dealt with, but it is really a cumbersome process for non-resident to have obtain PAN, file Form 10F, and then file income tax return for accessing a treaty. So let's dive into the what are the controversies in TDS related to foreign remittances. So first, we discuss the sale of software license. As everybody knows, the sale of software license has been one of the most litigated topic in Income Tax Act. So whether sale of software license, whether that be treated as a royalty under the Income Tax Act. So related provisions for the royalty payments are Section 9, subsection 1, clause 6, where the royalty payments have been provisions of the royalty payments are applicable. So over the period, the royalty definitions have been changed and even retrospectively changed by inserting an explanation 4, 5, 6 through Finance Act 2012 due to the Vodafone judgment which has come from a Supreme Court. So as well as whether these royalty payment for sale of software license were included previously as well or not. So I would brief this particular issue by giving a brief on engineering analysis case of Supreme Court. So Supreme Court has dealt with particular issue where sale of license was made by a non-resident supplier to an Indian Indian end user, maybe distributor or a reseller. So whether while making payment to the non-resident supplier, will it amount to a royalty and TDS under section 195 will be deducted or not? So while discussing this particular issue, or while deciding on this particular issue, in engineering analysis case, Supreme Court has laid down certain principles, such as one of the principle, whether the while sale of software from sale of software of software license, whether the right or right to use over a copyright has been transferred, or secondly, whether the retrospective amendment by making under 916 for royalty payment is clarifactory or impossible to comply. Then third is whether okay. So whether the royalty, whether the remittance for royalty or remittance for supply of computer software are distinct payments. So what is held by Supreme Court is, so while going through the agreements or end user license agreement, it does not create any interest or right in such distributor or end users, which would amount to use of right or use of any copyright. So it does not it cannot be treated as a royalty payment under the IT Act. While going for a retrospective amendment, for a retrospective or prospective amendment, Supreme Court has held that when amendment has been brought in 2012 with effect from 1476, it was impossible to comply with the amendment, or when it is impossible to discharge the obligation to amendment, the same cannot be applied retrospectively. So it is just a clarifactory with effect from 2012. You cannot say the TDS obligation was always intended those explanation to be in place at 916 explanation 4. So 916 explanation 4 provides that for the removal of doubt, it is hereby clarified that the transfer of all or any right in respect of any right, property or information includes and has always included transfer of all or any rights to use of computer software irrespective of medium through which such right is transferred. So while discussing this particular retrospective amendment issue, the court has discussed that the amendment introduced in 2012 retrospectively with effect from 1476, even when the explanation 3, which says computer software was for the purpose of clause, computer software means any computer program recorded on disk. This particular explanation was introduced only in 1991. Thus, it is very quite clear that the explanation 4 cannot apply to any right for the use of computer software even before the explanation 3 was introduced in the statute. Thus, it is very clear that the explanation 4 of section 916 of the Act is not clarificatory in nature, rather it enhances the applicability of royalty definition. The department was not satisfied with the rulings of the Supreme Court, so they have filed a review petition, which is till date it is pending. However, in certain cases, department is taking this particular argument for not following engineering analysis case, saying that review petition is pending. but courts are holding that till the date this particular um, decision is not overturned by the Supreme Court review petition. This uh, decision stands. So department have also come up with the alternate arguments for this particular sale of software license. So what they are arguing on this basis is engineering analysis case is decided on the conventional model of software. However, there are new modes of software such as online platform, SaaS, PaaS, all are new platform whereby the software is happening. So it does not apply here as a engineering analysis does not apply. Then they are saying this particular is a supply of the services. So fees for technical services should be uh, fees for technical FTS should be considered and taxed as a FTS. Then by providing sale of software or equipment, it creates P in India. So these are the arguments which are put forth by the department for arguing a particular case. However, engineering analysis is one of the case where Supreme Court has decided on similar issues about 150 appeals. So this is landmark judgment in this particular controversy. We move on to the interconnect usage charges. Under this particular uh, uh, under this particular controversy, Karnataka High Court in Vodafone case has held that while making payment to non-resident telephone operator for using of bandwidth or interconnect usage charges are not really a royalty. Further, it has also reiterated and followed the engineering analysis case recently and held that these are not royalty payments since the process or equipment were outside India and pay did not have a PE in India. So this is also one of mode of digital transaction and digital transactions like sale of software, interconnect usage are a very evolving space right now. Everyone is going for automation. Everyone wants to align with the AI, artificial intelligence. Everyone want to become an automated office or automated process. So while making a payment to a non-resident supplier, payer needs to consider a lot of things to not to default while deciding under section 195 or maybe as per the DTAA. So even here, Karnataka High Court has discussed in length regarding the chargeability under domestic law should not only be restricted, whereas double tax avoidance agreement should also be considered while deciding for a chargeability of the transaction. The then it has also discussed regarding the retrospective amendment with vis-a-vis prospective amendment, wherein also they have followed the engineering analysis case by saying that the whatever explanation have been introduced by Finance Act 2000 retrospect is not a retrospective in nature. It should be expanding the scope of the royalty definition itself. So it should be prospective with effect from 2012. So while discussing all this, what we understood is uh, the of onus of a payer has been widely uh, has made wide while deciding or while making a judgment whether the particular transaction will be taxable under domestic tax law or DTAA. Further, the courts have also held that where uh, the definitions of a royalty has been expanded under domestic law, but still the double tax avoidance agreement does not cover all such situations where the domestic law has been applied retrospectively. So, by going for a provision of Section 92, whichever beneficial provision should be applied, then as per double tax avoidance agreement, those nature of payment will not be taxable. However, while taking the benefit of a treaty, there would be other many compliances which needs to be followed by a non-resident supplier, as we discussed earlier. Moving on, as we already discussed in Karnataka High Court Vodafone case as well as engineering analysis case, this digital transaction through cloud-based services, through maybe platform which have been provided on a cloud, whether these amounts to royalty payment, so whether the platform is in India, whether it creates permanent establishment in India. So recently, the tribunal, Mumbai Tribunal in Amazon Web Services has dealt with these issues, wherein the tribunal has held that there is no right to use or right to use of copyright. So royalty payment cannot be made taxable under the Income Tax Act. The equipment from which the services have been provided are not at the disposal of customer, so no. So therefore, it is not a royalty payment. All such platform which are being provided are standard software. So thus, so the uh, make available clause does not satisfy. It has not been made available. Such services are not been made available. So fees for technical services also been ruled out. There is no equipment in India, so there is no permanent establishment has been created. So all digital transactions like sale of software, interconnect usage, cloud-based service are very evolving nowadays, and these particular issue will come to you for payment to foreign resident, and all such possibility for determining a taxability of a particular transaction, you will need to access to the treaty. Otherwise, you will end up paying higher tax under domestic law at a 20% plus such as cess. Whereas DTAA provides you lower rate or may not even be taxable under income under the India. So this is very wide space, you can say, and very evolving with coming to artificial even these government department is also alleging that um, these services may even be levy for equalization levy, since these are using the digital space. So mm, with everything going for automation, there will be huge onus on TDS obligation on taxpayer, not only with respect to TDS deduction perspective, but also from perspective of representation of a non-resident foreign company. As non-resident will have to determine correct tax implication while filing income tax return in India, since they have since payer has opted for passing the treaty benefit to non-resident pay. Okay. move on to the next topic. Next topic is very, you can say, very interesting topic of secondment. So, under the secondment arrangement, foreign company, generally group foreign company, depute skilled labor to skilled employee to the Indian group companies. So, whether this arrangement would particularly be treated as a fees for technical service. So while a foreign company is sending some skilled person to the Indian company, whether the rights or control are still with the foreign company. So control or rights related disputes are there. Then there are whose employee it is, whether it is for foreign company or it is for Indian company, whether employer-employee relationship has been uh, existed while working for a Indian company. Those employees are working for an Indian company. So there is no particular higher court judgment which has decided on direct tax perspective. There is one Supreme Court ruling in NOSS case where Supreme Court has dealt with this particular secondment issue where they have upheld that this secondment arrangement is manpower supply service and service tax shall be levied. However, coming to the direct tax perspective, uh, what is important term here is who shall have a lien on the foreign employee in India company, whether it is a foreign company who has a lien on employee works in an Indian company, whether it will be absorbed by the foreign company after completion of secondment assignment. So these are the areas where courts are deciding. So recently the Flipkart where this particular issue has come up, their Flipkart ruling, the courts held that while working for an Indian company, rights and control of an employee remains with the Indian company, and Indian company established the employer-employee relationship in India. So even when the Indian company reimburses the salary to foreign company for the employees worked in India, will have a TDS implication under section 195, and reimbursement will have to look at from the perspective of underlying transaction. So even if it is a reimbursement, still if the underlying transaction is a taxable, then you will have to deal with the 195 and DTAA and then decide whether it is taxable or not. So in this case, FTS were not made available to the Indian company, and employee did not stay longer to create a PE in India. So TDS was not liable to be paid as a fees for technical service. These are the issues while dealing for uh, foreign remittance, TDS on foreign remittance. We now move on to the third topic where the controversy is still open, and coming days these controversies will increase, and maybe some of the compliance uh, will become very complex, so that the uh, issues will be very wide. So, while we discussed overview of TDS and controversies in foreign remittances, so due to the change in the Finance Act 23 rate of tax for royalties and FTS, it has uh, it has made for non-resident very cumbersome process to follow in India for accessing a treaty benefit. So when a person issue a form 15CB for a payer to make a payment to a non-resident, they will have to follow certain procedure. Whether payee has a tax residency certificate for accessing a treaty benefit, whether the payee has filed Form 10F online by obtaining a PAN in India for just the purpose of receiving a money from a resident Indian. After accessing a treaty benefit, the payee will have to file an income tax return in India, and even payer will have to diligently review all those documents for the purpose of issuing, for the purpose of making payment. Because if you default uh, in deducting a TDS under 195, there will be a lot of consequences, even the penal provisions, which income tax department may hold you liable for that. So payer needs to take a lot of declarations from payee to mitigate the future risk. Otherwise, what will happen if you default, your expense will be disallowed in your corporate return. Then you will also have interest liability if you have not deducted or maybe short deducted TDS. There will be penal consequences for uh, late filing of TDS or maybe wrong filing of TDS. So these are the things one payer need to keep in mind while making payment to the for a non-resident. So looking at the controversies and looking at the digital transactions, one may say this space is evolving, and day by day it will become very complex, and there will be a lot of litigation on this particular topic. Though as of today, this is the most litigated topic, whether the TDS will be liable on foreign remittance or not. Because in most of the cases, DTAA favors to the assessee. DTAA always favors to the assessee, since DTAA is meant for providing a benefit to the foreign companies. Otherwise, foreign company will not transact in India. So the more complexity, more litigations will evolve from all these amendments, which have come over the 3-4 years or 5 years. Let's see how world will react and how it will be implemented in future as well. There are certain topic which will actually stop you from accessing the treaty. So if your transaction is only for purpose of taking the tax benefit, then under the domestic law, there is a GAR, General Anti-Avoidance Rule, which says that particular transaction will be denied. So it empowers revenue authority in a country to deny tax benefit of a transaction or arrangement which do not have any commercial substance, and only for the purpose of such transaction is achieving the tax benefit. Then recently there are MLI related issues where assessees have been denied the tax treaty benefit because due to the principal purpose test. What it says, by means of principal purpose test, the tax administration can deny the benefit of tax treaty if one of the principal purpose of the action by taxpayer was to obtain a benefit, tax benefit. So for deciding principal purpose test, there is a ownership based test also, how frequent this particular payment is. All such test needs to be examined. But while while making a payment, how will the payer know all such principal purpose test or maybe ownership based test whether such questions be asked to non-resident supplier on a free basis. How will a payer know? So the obligation on a payer is quite high. Then limitation on benefits. Every double tax avoidance agreement has this particular clause where the benefit of double tax avoidance shall be limited to only one state or maybe on the basis of ownership. So in certain double tax avoidance, it is based on ownership. In certain double tax avoidance, it is based on residency. So that is only so if a particular person has been denied benefit on the basis of LOB, then the government of that state uh, needs to inform to the other state that we have denied the benefit on the uh, on the basis of their residency or maybe on ownership basis. They need to provide such clarification. Now we move on to the most favored nation clause. This particular clause, how it works. So, for example, uh, there is a DTAA between India and a USA. For example, there is a DTAA and between India and USA has a most favored nation clause, whereas India has also DTAA between some small country like Colombia, where the treatment of that Colombia state under the law of A is most favored compared to DTAA between India and USA. Then, while applying for that particular transaction, resident of USA can invoke DTAA between India and Colombia, and that most favorable treatment given to the resident of Colombia can be imported in similar text in the similar situation. So this particular clause have been included in some of the treaties like Switzerland, Netherlands, or maybe more 4 5 countries who are OECD member for DDAA. So of late, many countries have invoked this most favored nation clause while discharging tax on dividend. So our next topic is dividend income only. So I'll brief this particular issue in the next slide. So while making payment for a dividend income up till 1st April 2020, no, 31st March 2020, the DDT has to be discharged by the company and shareholder will not have to pay tax on it. However, after the 1/4/20, the DDT has been scrapped and dividend tax has been introduced and it has been passed to the shareholder. So now shareholder has to pay tax on the dividend income. So here the area of dispute for a foreign remittance with respect to dividend income is when you make a payment to, like, say, Switzerland or Netherlands, where the most favored nation clause is there in the double tax avoidance agreement, and there the dividend tax is about 10-15%, whereas you have a treaty with Slovenia or maybe Colombia where the dividend tax is at 5%. So Netherlands or Netherlands resident wants to invoke the most favored nation clause available in the double tax avoidance agreement and imported into DTAA between India and Netherlands. The rate provided in the DTAA of Columbia of India, DTAA of India, Columbia. So this is particularly the current dispute which has yet not been clarified or may not be or have not been decided by the Supreme Court. It is, I think, as I rightly know, it is still pending at Supreme Court whether such provision can be imported in the uh, while making payment for a dividend by a shareholder. So how will the payer would know all such thing while making payment to the non-resident? That is the crux of the transaction. Whether payee wants to invoke the MFN clause, whether such declaration be taken by the payer, and on the basis of declaration, whether payer deduct the tax and pay to the government, whether it will be allowed or not. What all future litigation will be handled by the payer while taking all such declaration, while replying to the responses to the income tax department. So this is, as of now, is fully open. It has not concluded. There are certain updates by CBDT saying that this cannot be invoked. This is not the intent of the law. All such updates are there. However, as of date, it is not final. It has not been decided by the courts. It has not been decided by the Supreme Court. So this is the open issue. I think that is all from my end today. So thank you. I would be happy to take any questions you have. Thank you.
Thank you, CA Nilesh Karya. We have a couple of questions.
Yeah.
Just a second. Yeah, so the first one is withholding taxes applicable on online foreign payments for access to online services? Example, GitHub.
Sorry, I didn't get last portion. Which example?
GitHub, GITHUB.
So yeah, so here the transaction is basically a digital transaction. So one needs to determine whether it is uh, providing any fees for any technical services in India or not, whether payment is made to the person who has a permanent establishment in India or not. So while determining taxability, one needs to see whether the any technical service has been provided in India or not, whether permanent establishment in India or not. And secondly, one may also go for a whether the equalization levy has been levied on such particular transaction. One may come out from the TDS provision. So if the equalization levy is already held on online transaction, then there will not be required to deduct TDS. As of today, that is the stand taken by everybody.
Okay. Okay. So the next question is, if an Indian company hires an employee outside India for work outside India, Indian company pays salary as well as commission of certain percentage on sale made by such employee. Will TDS be deducted on such commission paid to outside India employee?
So here the employee-employer relationship is there between Indian company and foreign employee. So it will be governed by Section 192, and on the salary portion, there will be a TDS provisions applicable.
Okay. Okay, sir. Thank you. So now moving to vote of thanks. On behalf of Women and Young Members Excellence Committee, with great pleasure and gratitude, I extend a warm and sincere vote of thanks to our esteemed speaker, CA Nilesh Karya, for his informative speech. You have covered the topic in depth, starting from TDS to TCS, DTAA, and then what are the controversies around this area. Sir, we are truly honored to have the opportunity to learn from your expertise in this complex and crucial subject matter. Your presentation has shed light on the recent issues and judgments surrounding withholding tax, which can be applied in our real life scenarios. We are grateful for the time and effort you have invested for this webinar. Thank you once again for gracing us with your presence and expertise. So, I would now like to request CA Dimple Gogri to introduce our next speaker for today.
Good evening, friends. Myself, CA Dimple Gogri, who has been given this pleasant task to introduce today's learned speaker before this gathering. Today we have with us CA Vishal Mulchandani, who has chosen the path of entrepreneurship in his early age of career and started his own venture, Black Horse Excellence, which is India's first organization designing and developing Excel-based automation tools for chartered accountants. Previously, he had worked in Tata Consultancy Services Limited for 3 years in corporate finance. He has been an author of various articles on online platforms like TaxGuru on different automation topics, and we all are sure that he shall make us more literate on various topics of Excel automation with special reference to financial reporting in these days of technology. Thank you, Vishalji, for accepting our invitation. Over to you, sir.
Yeah, thank you very much for giving us an opportunity to give a presentation on the automation tool. Let me share the screen. Yeah, so good evening, all the members who have joined, who are watching the live session of this. So you must have attended many many webinars and seminars on the Excel automation. Even in that, we are being taught VLOOKUP, Hash lookup, SUMIF, formulas, pivot charts, and whatnot. So there are so many things which in those Excel seminars, that thing is being taught. But today, I will not be teaching you all of this because Excel itself can do all of this by automatically. So there are automation tools available which can do lots of things in the area of financial reporting by its own. So there are actually 3 automation tools. Schedule 3 automation tool, which is primarily for the private limited companies falling under the non-Ind AS. Then there is a balance sheet automation tool that is for the non-corporate entity. And then there is one more Ind AS automation tool for listed entities. So what does this automation tool do? So this is primarily doing, there are certain options, features like it is integrated with Tally ERP9, Tally Prime. So with the one click, you can import data from Tally to the automation tool. It generates automatically notes, schedules, then it calculates depreciation as per the Companies Act, as per the Income Tax Act, computation of tax, deferred tax calculation. This is all being done by the tool itself. It is designed up to such a level that it can even do a consolidation up to 25 branches as per the AS 21. It is further integrated with certain ITR filing softwares like Winman, Spectrum, ClearDex, and Serality. So we will see all of this on live data itself. So now I have shared the screen wherein this Schedule 3 automation tool I have just open up. And this is, this we can see this is entirely Excel based thing. And here we have divided most of all the things into different sheets. At the bottom, if we see, there are 5 tabs: Master, TB, FAR, QDisk, and RDisk. These are mainly 5 main input sheet. Then there are certain output sheet. Those are denoted as a green sheets: balance sheet, P&L, cash flow, policies, notes 1, 2, 3, and all. So those are the output sheet, and rest all the sheets are working sheet that will be useful for our working purpose. So let us begin with the master sheet. In master sheet, we have given options like you can put the detail of auditor, generally the financial being prepared by auditor or even for a company, so that information of company as well as for auditor, we can put it up over here. Then there are financial preparation options that we have given over here. As I said, you can do the consolidation, branch consolidation you can do. If you have a multiple units, you can do a company consolidation. You can do you can even prepare a standalone financial in case you want to prepare depreciation as per companies act. If you want to calculate that also, you can do it in this. Then in small company, if cash flow is not applicable, so you can select no. In case of cash flow is applicable, you can select yes. So according to that, the cash flow will be generated. As I said, the ITR6 will also be generated in this, so that ITR6, whether you want to generate or not, that you can select from here. Then there are certain other presentation options. Now we know that from financial year 21-22, we need to give this financial in round off. We will have to round it off in thousand, lakhs, crore, and so on. So that you can select the option of the rounding off, you can select from here. Now we even know that it has been 2 years that we have been preparing financial in round off. So one said we have to prepare for company's financial in thousands or lakhs, and another side we have to prepare for ROC filing, for ITR filing, that has to be in the normal rounded off figure. So that itself you can do it all automatically over here with the one click. Then let's say you are converting financial in lakhs. After that you want two decimal places, so that also you can select from here. Now from presentation point of view, we have given two further presentation options like color theme. If you want, you can choose from here. There are default 8 themes available. Then there are layouts that we have given. The layouts is basically for bordering options, so those combinations are also given. Now we, when we prepare a financial, we would even be interested in knowing what is the year on year change. So that year on year change on the face of the balance sheet P&L, whether you want to view or not, that also you can select from here. Then there are certain other options like you want to give off the print of financial. Then there is a PDF export that we have given, Excel export we have given. With the one click, you can generate a print of the entire sort of financial. So these are all the options that we have given. So ultimately, this master sheet is going to be your control sheet of your entire financial, and all option you can select from here. Now, let us come to the trial balance sheet. Here we will import one live data itself. Now, I have one of the tally data open over here. Now, whenever we are working first time on this tool, we first have to import data for the previous year. Assuming that I am preparing financial for 2022-23, so my previous year will be 2021-22. So it is very simple. Like simply you have to select, open the tally and select the period that you want to import. So here period which is selected is 21-22, and just come to the tool. Here there is one button given, import from tally. Just click on this button. Whatever data is open in the background in tally, it will import data for that particular client, and it will import data for the period which is being selected. Yeah, so once it is being imported, you can see over here the trial balance from tally has been imported. And after it is being imported, if it is a entity with the stock, we will have to do adjustment for stock and all. So we can see over here, this multiple columns has got filled up. Now let me explain what all these columns are there. So first two column, it has actually imported the trial balance in a structured manner. The first two column is the tally's grouping. First one is the tally's primary group, and second one is the tally. Whenever any user is working on tally, they can also we are also able to create a group, so that whatever user defined grouping is that will come as a second line item. Then there is this name of the ledger, and after that there is this amount column. Now, there is no separate column for debit and credit. There is this single column, debit is positive, credit is negative over here. As I said, after importing, we will have to do one of the stock and P&L adjustment. So let me just do that. The adjustment that we need to do is, we need to come to the tally, and we will see whether the profit is transferred or not. This is the first adjustment. If the profit is transferred, then this adjustment will come. Why this adjustment will come? Because while importing data from tally, it is importing all the P&L ledgers, as well as it is importing all my it is importing the ledger of reserve and surplus, wherein this balance is already being transferred. So there is a double impact of this profit which is being transferred. So if profit is not transferred, then this adjustment will not come. If profit is not profit is transferred, then this adjustment will come. This is one adjustment. Another adjustment is what is my opening closing stock difference. So the difference of opening closing stock is over here, change in stock, that we will enter over here. Since my stock is increasing, so I will put that as a change in stock. Now my trial balance is tallied. If trial balance is not tallied, let's say if I put some figure by ad hoc, so it will give me a difference in top of that column that this trial balance is not tallied. So this once our trial balance is tallied, then we need to do a most important part of this tool, that is the grouping. The grouping is divided into 3 different levels. The first one is the phase grouping, which we need to select from the drop down list. For example, this first ledger is related to the trade receivable, so I can put this trade receivable. The drop down list containing all the grouping as per the schedule 3 guidance note. So according to that, this all the groupings are available. So once you select the phase grouping, after that you can select the subcategory of this phase phase grouping. So here we can select under the trade receivable whether this is the secured, whether this is unsecured, whether it's a doubtful or a provision for doubtful debt. So according to that we can select. And subnote grouping is open-ended. Whatever user want to write, they can write there. Now, let me take one more example. This is accounting charges that the company has paid. So where do we want to classify on face of the balance sheet and P&L? Of course, this will go into the other expense. So we'll just select that. Once you select the other expense, then we can select note grouping of the other expense. So this can be grouped under the any of the appropriate head. And further, if you want to give a breakup of consultancy expense, as I have group this under the consultancy expense. So if I want to group this under accounting charges, I want this thing. So we can write that as the subnote level. Now, it is not that this all grouping you need to do it manually. We have even done the automation over here also. You can click on this button, apply default grouping. So when you click on this button, apply default grouping, tool will try to do a majority ledgers grouping by automatically. Somewhere around 50 to 70%, the grouping will happen automatically. And whatever grouping cannot be done automatically, that it will leave it blank. It is upon user to do it. And that is also only for the one time. So only one time that remaining grouping user will have to do. Now here also, if we see the grouping, there were somewhere around more than 250 ledgers which were imported, and out of that now in the phase grouping only 42 ledgers grouping is pending. So this we can see in node grouping there is a 80 ledgers for which grouping is pending. So this grouping we need to do, and this also we can complete one by one. Let's just see how we can do this. So I will just filter the group all the ledgers which are grouped under the deposit. If one ledger is blank, then all the ledgers under that will be blank. So this should be grouped under the other non-current asset. Under that, once we select the phase grouping, after that we can select the security deposit. And this we can copy to all the similar ledgers which are falling under that. So this will make our task of doing a grouping also very quickly. Let us take one more example of a fixed asset. So I have selected fixed asset and I'll just filter that now. So this should go into the property, plant and equipment. I have grouped one ledger. I'll even give a grouping of node grouping, and then I'll just copy this and I'll just paste this for all these ledgers which are being there. Yeah, so this is making our task of doing grouping very quickly. And this is how we can do the grouping. Now, if I come to the balance sheet, the numbers, the grouping that we have done, based on that, the numbers will automatically flow over here. As I was explaining that it will import, first time we will have to import data for the previous year, but it is showing this data in the current year. It is showing this data to me in the current year as well in the balance sheet as well as in the PLN. So the process is that first we will have to import data for the previous year. We will have to complete all the grouping. All this grouping we will have to complete. And then in the right, there is one option given, move current year data to previous year. Simply just click on this button, move current year data to previous year. So this will shift all your data from current year to the previous year with all grouping and everything. And it will only in the current year, only amount will get deleted. Whatever grouping that we have done, The beauty of this tool is that whatever grouping that we have done, that will remain as it is. And this will save majority of your time from your second year onward. Somewhere around 80 to 90% time you will be saving by using this tool once you just import, once you complete for the first 2 years. So as we can see now in the balance sheet and P&L, the data has got shifted in the previous year. Now let us come to the TB again. We will import now data for the current year. I'll open tally data for 2022, 2023. So this data is open over here, and just simply click on this button, import from tally. The tool is so smart that it will automatically assign the new balances to all these existing ledgers, and whatever new ledgers are there, it will get automatically imported at the bottom. So we have up to row number 254, we are having the existing ledgers. Now if I just click OK, it has updated all these existing ledgers, and whatever new ledgers were there, those are automatically identified and just has been imported below this. Now we will only have to do a grouping for this incremental ledgers. That's it. So first time when you are doing, you will have to do it for the previous year first, and then we can import data for the current year. Now if we come to the balance sheet and P&L, we can see there is a data for the current year as well as for the previous year. In the balance sheet and P&L, we can even see that there is a comparison which is being shown with the year-on-year percentage change. So you can even have an analysis in terms of percentage ready over here for your review. Now in balance sheet and P&L, our task is only that which notes that you want to prepare, because your financial once your grouping is done, then your balance sheet P&L is ready in printable format. You will only have to select yes and no for the notes that you want. From here, from drop down list, you can select the notes that you want. It will automatically reassign the numbering of the notes, and subsequent note numbering will also automatically that will also get automatically reassigned. Now if we come to the balance P&L, in P&L also we will only have to select yes no for the notes that we want. So here there is an option given. The notes that you want, you can see in column E, there is a note numbers are assigned. So when we select yes, no, that gets automatically rearranged. So this type of many small mistake when we are preparing financial manual in Excel, those all can be avoided. Now we can come to the notes. So notes, once balance sheet P&L is ready, then we can prepare the notes. So that also can be, that will also be done by the tool itself. There is one button given in the tool, that is the prepare notes. This prepare notes button has been given in the tool. When you simply need to click on this button, and it will generate all the notes automatically, taking a base from the trial balance, and it will generate only those notes which we have selected yes in balance sheet and P&L. Now, since if I click on this button, it won't allow me to generate the notes because it is giving error that first you complete the grouping, after that only you can prepare the notes. So here the grouping is not complete. So I have already one company where we have completed the grouping. So let me open that data. Yeah. So here there is one data where we have completed grouping for current year as well as for the previous year. So for previous year also we can see the grouping is complete for all the ledgers. Now this data has been converted in the master sheet. We have selected option rupees in lakhs with decimal places yes. So here you can see in the balance sheet this financial has already been converted. Now, while you must be have experienced that whenever we convert financial in rupees in thousands or lakhs, we always get a round of difference. Generally, it is called as a casting difference. Now, we have even designed an algorithm in a way that it automatically adjusts that rounding of difference, and it automatically, based on the data, it will assign the whatever difference is that, it will automatically assign that. In P&L also, if we come over there, this has also been converted in lakhs with decimal places. Now, if we come to the notes, we simply need to click on this button, prepare notes, and it will generate all the notes automatically. Within 30 to 40 seconds, it will do all page setup, formatting, editing, and everything done by the tool. These notes are divided into 4 different sheets. First one is the notes one, which is going to cover all your shareholder as well as liability related notes. These all notes are related to that. This all are generated when we have clicked on the prepare notes. Then there is a notes 2, which is going to cover all your block-wise detail of a fixed asset. So addition for the fixed asset, deletion for the fixed asset, depreciation for that period, it will be captured from FAR sheet. I will come on that also. I'll explain how depreciation in this tool can be calculated. That will also be, I'll explain you. Then there is a notes 3, which is going to cover all your this asset as well as P&L related notes. So starting from non-current investment to all the notes of current asset, all the notes of non-current asset, trade receivable, aging schedule, all this you can see over here. After that, there is a P&L notes, revenue from operation, purchases, changes in the stock, and up to the taxes expense. All those notes will be captured over here. After that, there is the fourth sheet, that is the A disk. A disk is basically for what? Generally, whenever we prepare a financial of the companies, there is no any there is a disclosure requirement of accounting standard, and there is even a requirement of Schedule 3 guidelines of the disclosure requirement. So those all the disclosure doesn't come from the trial balance. So those all will be captured over here, and that will come from the Q disk and R disk. So what all are this disclosure? This will include earning per share disclosure, auditor's remuneration, contingent liability, MSME disclosure, related party disclosure is that. After that, there is the new regulatory disclosure which has came from 20 financial year 21-22. Then ratio analysis is there. After that, there is other statutory disclosure which we are showing as a part of the financial that can be shown. So this doesn't come from the trial balance. So where do we need to fill this data? So this we need to fill in QDISC and RDISC. This one sheet is QDISC. QDISC stands for the qualitative disclosure. Qualitative disclosure will cover all the disclosure of Schedule 3, all the disclosure of accounting standard, whichever disclosure is applicable to the company that we need to fill. That also I'll show it to you. For example, this share capital. This disclosure will be applicable in all the company, like authorized share capital we need to show. Then we need to show what is the reconciliation of share capital, shareholder holding more than 5%, promoter shareholding we need to show. So that we can fill in this tab. Then if the company has a long-term borrowing, so let's say you want to show that thing. So just click on this long-term borrowing tab, and just the tables for the disclosure of that will open over here. So we can just add over here, like what is your disclosure related to that. Let's say I'm just adding over here. So this disclosure we can add. Let's say we want to even add the footnote. So that also we can add as any textual footnote that you want to show, that you can add over here. Now we are adding this disclosure over here. So how this will be presented in the financial? So for that, simply for a navigation purpose, we have given one shortcut, the Control Q. Simply click on that, and that will take you directly to the output report of that table. So we added the terms of repayment. So here we have added that, we can see that has automatically captured over here. One footnote also we have added. So that is also captured over here. Let's take one more example. Let's say we want to add one more footnote for this short-term provision. So simply select any cell over here and press a Control Q. So this will directly take you to this input sheet wherein short-term borrowing disclosure will open. Now this disclosure I have already added. Only thing that this I have not selected yes for a disclosure purpose. I am now selecting yes, and I'll just click again Control Q. So this is taking me back to this particular sheet, and over there this disclosure has got added. So this is how very easily you can add whatever the qualitative data are there. Let's take further what all are further new disclosures are there. So this is covering all the, as I said, accounting standard disclosure, trade receivable, trade payable, aging schedule also, that cannot be generated in this tool. That generally for generating aging analysis, you would require transaction-wise detail. So from any accounting system, we can always generate a aging schedule. So that aging schedule for disclosure purpose, we can punch in the data over here. This ultimately should tally with your total as per the trial balance or balance sheet. If it is not telling, this gives you a check over here. So the user who works on this tool always get highlighted whenever anything is pending or whenever any error is being and error is occurred. Let's take few more example. In this, there are further disclosures of the accounting standard 15, that is the employee benefit disclosure. It covers your gratuity as well as leave encashment disclosure. There is further disclosure of segment reporting. There is a disclosure of foreign currency disclosure. There is a disclosure of related party disclosure, which is applicable for most of all the entity. So in related party, there are three types of tables which are being there. One is the list of related party, another is the related party transaction, and third one is the related party balances. So this is how you can mention all your related party transaction, and then we need to click on this button, add to ADIS, and the data will get automatically captured in this ADIS sheet over here. We can see this is the related party disclosure. Then there is one regulatory disc. Regulatory disc means regulatory disclosure. So this is covering all the regulatory disclosure which are applicable from financial year 21-22. So whichever disclosure is applicable to the entity, we can click on the tab of that. So in this one of the entity, we have a capital work in progress. So we need to give the aging schedule of that, so that the data we can punch in over here. Then if the company has borrowed amount on their working capital, so we need to give a reconciliation of stock statement that they have submitted to the bankers. So if there is a variance, this thing you can, this table you can fill in that scenario. Then we have a regular ratio analysis. So ratios we can, here ratios, most of the ratios will get captured automatically from balance sheet and P&L. But then still there are certain ratios which would require additional information to be entered. So that can be entered in this table, like earning available for debt service, what is your interest and principal repayment for calculating debt service coverage ratio. So these things are needs to be entered by user over here. So these are the all this regulatory disclosure which we need to fill in the ADIS regulatory disclosure, which will get automatically captured into the ADIS. Now there is one more report which can be generated in this automation tool. That is the annexure report. This report is going to be a most important report, because what happens, financial we prepare anyhow. We always prepare a financial, whether it's in manual or not. But for that financial is covering what grouping that financial is covering. So that grouping, when you click on this button, prepare annexure, it will generate all those ledger wise breakup of entire financial. We can call this as a grouping, subschedule, or annexure also you can say, and that will get generated when you click on this button, prepare annexure, within a 2 minute itself. And this will be automatically in printable format. If you give this to the client, to the accounting, this will give a very good impression that as a organization we have performed so better. The report is very much presentable. This you can see at no place it is coming, no page breaks are coming. This is all being generated with a one click within a 2 minutes itself. Let me explain you what is the difference between annexure and the notes. Let's take an example of the long-term borrowing. In long-term borrowing, if we see, there is a secure term loan from bank. Under that, there is this two ledgers are coming. HDFC Bank term loan, the ledger wise balance is coming. Under the unsecured term loan, again there is a ledger wise breakup is coming for 6, 7, 7, 8 line items are coming for the ledgers. Now, if we see how this looks in the financial, that will be in the notes one, being it is being a liabilities part. So over here under the long term borrowing, we only see over here only the main headings. The breakup of this is available, the ledger wise breakup of this is available in the annexure sheet. So this is very important during the department presentation. So whenever there is a scrutiny or assessment, the department always asks for the ledger wise breakup of entire financial. So this will be very easily and readily available with you. Simply we need to click on prepare annexure. One very important sheet that we have given for a principals or for a reviewer who is reviewing the financial, that is the check sheet. In this check sheet, there are more than 170 checks for entire set of financial. If there is any error, if there is any mismatch, if there is anything which is not matching with your base financial, if there is any mismatch between balance sheet P&L versus the notes or versus the annexure, so that mismatch you will be notified over here in this check sheet. So at present, if I show it to you in this particular financial, I'm getting this 20 checks. Out of this 20 checks, there are majority checks related to the negative balance. It even gives you a negative balance check also. So what is that actually? In the trial balance, In the trial balance, if I have grouped any ledger, if I have grouped trade receivable, which is having the credit balance under the trade receivable, if I have grouped, so that it will highlight to me in the check sheet. So check sheet is going to be a very important from the review of the financial point of view. Ultimately, we just need to ensure that before we are printing the financial or before we are giving the finalizing the financial, we just need to ensure that all our checks are resolved or not. So this will, once our all checks are resolved, primarily the financial is not having any errors. Now there is one more report, as I said, that which can be generated in this, that is the FAR. So this is FAR sheet. In this, you can actually enter the certain basic detail of asset. Or let me explain you what all are the details that we need to enter over here. We need to enter over here what is your type of the asset, name of the asset, what is the category of the asset, whether it's a plant and machinery, land, building, vehicle, or what. Then we need to enter what is the cost of this asset, what is the residual value, then what is the date of put into place that we can enter. Then we can even enter what is the useful life of that asset. Then we can select whether what is the method of depreciation that entity is following, whether it's a SLM or WDV, that we can select from here. After entering this basic detail, simply click on this button refresh. So once you click on this button refresh, it will calculate depreciation for all the asset for entire life. Let me show it to you one perpetual depreciation chart. So this is the perpetual depreciation chart, which has automatically generated based on the data that we have put it in the FAR in that input sheet. This is integrated with notes part 2. So your data which is there in the FAR, that is synced with this notes 2. Here simply we will have to select the block of year. We will have to select the block of year. Let's say I want for 22, 23. So if I select that, it will give me the opening balances for that, depreciation for that, addition, deletion for that period only. It will give directly from the FAR sheet. So that thing can be prepared from here itself. Now in this, you can maintain asset up to the 5,000 line item. So 5,000 line item is a huge number for any private limited company. So that up to 5,000 line item assets you can maintain in this single sheet. In single sheet, FAR is maintained. In single sheet, depreciation as per the Companies Act has been calculated. So this will be very important. Even there is one of the clause that whether in the CARO, whether the company is maintaining fixed asset register or not. So that will get also fulfilled in this with this tool itself. An output report can even be exported in normal Excel. Let's say if you want to share this data with client after generating this data with client, if you want to share you can click on always Excel export, and that this data will get exported in normal Excel. Now coming to once your financial is ready, then you can simply click on this button print financial. So that will give you first a preview of entire financial, and then we can just have a view of that, and then we can go ahead with the printing. So this is 22-page financial, balance sheet, P&L, cash flow, accounting policies. Then there is this notes 1 starting from the share capital. Then there is this trade payable. Then there's this fixed asset schedule. Then this all asset as well as P&L related notes. After that, these are the notes related to the ADIS. And at last, signatory detail comes in. So this we can see very much presentable financial, which has been generated with the very short span of time with using this automation tool. No need to learn any high advanced Excel formula or anything like that. Simply, we need to follow a process how this tool can be utilized. There are input sheets has been given, so that data we need to enter, and that data, after entering that data, we can generate the financials. Now let me take you to the advanced part of this Excel, the consolidation. How consolidation can be done. So to do the consolidation, we need to select branch consolidation or a company consolidation. Then just come in the right in the master sheet. Here we need to define the name of the branches. I have already defined 3 of the names like Delhi, Mumbai, and Pune. These are the names that I have defined. Up to 25 branches, you can do the consolidation. So as of now, I'm just taking the example of 3. So let us come to the trial balance now. Once you select the branch consolidation, you will get one more column in this. That is the name of the branch or name of the company. So here the process of consolidation is that we will have to import data for all the branches one by one, and that data will get merged one below one. So here I have already imported data for one of the branch, as in this the data which is being imported over here is for Delhi. So now let us import data for Mumbai. So in cell A1 we will have to select that the branch that we are importing. Now let us assume that the data which is open over here is for Mumbai, and just click on this button import from Tally. And it will even ask you that whether you are importing data for Mumbai, that the data which is open there in Tally is correct or not. If you are by mistake click on import from Tally, you just click say no. So it will not import data. That is just to avoid if there is error happens. So after let me import now. I have selected yes that we have open correct Tally data for Mumbai. So now what this tool will do, it will merge the data for Mumbai just below this Delhi trial balance. Yeah, this the message comes in over here. The tally data for Mumbai has got imported. We can see over here just below the Delhi up from row number 589, just below that Mumbai trial balance has got imported. Now, the most, as I said, that the most beautiful part of the tool is that the grouping that you have done, that you will not have to do again. Again, just simply click on this button, apply default grouping. So whatever grouping that we have already done for the previous branch, that is for the Delhi branch, whatever grouping we have already done, that will remain unaffected with this. So it will, the grouping for Delhi will remain intact as it is, and it will do automatic grouping for the new branch new ledgers, whatever we have imported now. We can see previously there were 322 ledgers for which grouping it was showing us pending. Now it is showing us grouping pending only for 42 ledgers. Now in the balance sheet, the data that we get over here is consolidated. In the P&L, data that we get over here is a consolidated notes, annexure, whatever we will be generating after this. Once the grouping is done, then if you click on this button, prepare notes. So notes and annexure will get generated, consolidated. Now from consolidation point of view, we have given 3 additional sheet. One, branch balance sheet. Here you get the branch wise balance sheet since we have imported data for 2 branch. So for Delhi and Mumbai, it is giving us a balance sheet over here, standalone balance sheet. And here there is a branch wise P&L. So there is a for Delhi and Mumbai as well as Pune, we have not yet imported. So it is coming blank. So branch wise P&L also we get generated over here. There is one more report which can be generated in this tool, that is the elimination report. So elimination is what? Whenever there is an inter consolidation, so there is always an inter branch transaction. So that inter branch transaction can be eliminated in the trial balance. I can just directly jump to the trial balance with the shortcut Control T. So this all shortcuts are defined in this. And yeah, just coming to the point. So elimination can be done in the trial balance over here. There is one column that we have given intercompany balances. So how we need to eliminate the transaction? Let me just give you a scenario how this thing can be done. For example, I have this transaction, the freight charges that we have paid, that is my inter-branch transaction, 9,15,388. This I have paid to my branches. So let us say that I want to eliminate this. So what I can do, I can just against this ledger, I can just simply select the branch against which I have paid this amount. So for example, I have paid this against Mumbai. So this amount will get eliminated. This is the expense that we have eliminated. We have not yet eliminated the revenue. We will eliminate revenue also. And let me come to the elimination report. So here we can see in the elimination report, it shows us a difference because we have only eliminated only one transaction. Expense we have eliminated. We have not yet eliminated the income. So that gives us perfect red mark in the income. So this how we can read this in the books of Delhi. against Mumbai, expenses has got eliminated. And in the books of Mumbai, against Delhi, there is a income which is not yet eliminated. So there is a two table. One is the elimination difference table, and below that there is one more table, that is an intercompany transaction which has been eliminated. So in the below table, that will give you a total of the transaction which has been eliminated, and in the first table it will give you if there is any elimination difference. If there is no any elimination difference, it will not give you any difference over there. Now let us eliminate the revenue part. Now let me give you one more example. Let us assume that the Mumbai, which is booking their revenue, they do not have a branch-wise separate ledger. They do not have branch-wise separate ledger for their income. So we will have to pass one adjustment entry. Let us now take one more difference example, that they have booked only revenue of 9 lakhs rupees. That 15,000 invoice they have not yet booked. Let us assume that in that way. So we will show how report it will how in elimination report it will show us a report. So I'll just group this. And against the transaction that is credited, 9 lakhs rupees is credited, that's my revenue transaction. Against that, I'll just select Delhi. Now, if I come to the elimination report, it gives me only difference of 15,000. And in bottom, there is one more table that is containing the total of the transaction which has been eliminated. So here we can see the expenses which has been eliminated is 9,15,000. And then the income has been eliminated only by 9 lakhs rupees. Yeah, so in this, this thing has been generated. Now let us say that we want to eliminate this in full. So I'll just book the revenue at the full. And now if we come to the elimination report, we will see there is no any elimination difference. The difference has got nullified. And at bottom, yes, you will even get notified that the total of the transaction which has been eliminated in the total of the transaction for the intercompany. Yeah, so this is as far as the consolidation is concerned, these are the things. This is how even you can do a consolidation for companies also. If there is a subsidiary company, that also you can import like this only, and you can do a consolidation. There is one more report that we can generate in this tool, that is the analysis chart. So here we can click on this button, refresh chart. When you click on this button, refresh chart, it will calculate all those charts. There are certain charts like profitability chart, profit and loss chart, top 5 income, top 5 expense ledger, top 5 income ledgers, top 5 customer balances. Year on year comparison, you will get top 5 creditor balances, balance sheet numbers, year on year comparison. Even there is a cash flow charts also, which is being in pictorial format being presented over here. This can be very useful while presenting the data to the management, or even while presenting data to the for audit purpose also. There is one more additional utility of this tool, that ITR 6, ITR 3, 5 and 6 can be generated in this automation tool itself, which is integrated with certain softwares like Computex, Winman, Spectrum, SmartX, SerilIT, ClearDex and so on. So from this tool, the data can be exported into the respective. This all software gives Excel template to import the data in their software. So from this tool, data will get exported into that Excel template of the respective software, and that Excel template then can be imported into the respective software. This will be a very much huge time saving while during the deadlines. We always for ITR filing, we will be always putting a manually data only in the ITR balance sheet, P&L, trading, manufacturing account, and so on. So that this task can also be automatic using this automation tool. The cash flow will also be generated from the tool itself. The cash flow sheet over here we can see this is being generated directly from the trial balance. There is a separate grouping available for the cash flow. There is a two level grouping. Level 1 grouping will be done automatically. Level 2 grouping is specifically bifurcation. For example, we have to separately disclose bad debts, gain loss on sale of investment, if there is any loss on sale of asset, this kind of transaction for investing, operating, and financing activity bifurcation, we will have to separately disclose this thing. So this you can select from here. It is not applicable for all the ledgers. It is only applicable for certain ledgers, which it will highlight to you in red. For example, this is investment, which we'll have to select at level 2. So whether this investment is in equity, mutual fund, shares, or it's in the term deposit. So we can select according to that. So once this grouping is done, then your numbers to the cash flow and CFS sheet to the cash flow in the operating financing activity, it will flow automatically from the trial balance itself. There are certain many other small things that we have integrated in this tool. This trial balance, all this phase grouping and node grouping are integrated with ICAI's guidance note on the schedule 3. For example, if you select any of the grouping and just click on the shortcut Control G, that will give you one or two short line which is very important to that grouping with that guidance note para number. So here it says that guidance note para number 8.4.1, our trade payable shall be classified, which is the amount which is being due for the goods purchased or services being rendered in normal course of business. So this is also very important. Let's take one more example, because the person who are preparing the financial, if they are facing any, if they need any clarification while doing this grouping, so they can get to know some insight related to the each grouping. So this is also the guidance note para reference number with relates to salary and wages. Let's take one more example. There is one very important paragraph has been explained on the other income. So if I click on Control G, so there are three very important distinguition has been explained with respect to other income as well as with respect to other operative income. So this thing with reference to that guidance note can be seen very much in detail from here itself. So similar to this, we have automation tool for non-corporate entities as well. One is the general tool, and another one is as per the ICA's technical guidance note. In June 2022, Institute has issued a guidance note for non-corporate entities as well as for LLPs as also. So for them also, which is mandatory, which was optional at that time, but which is now mandatory from financial year 2024-25 year onwards. So this automation tool is also helpful for non-corporate entities. Here, this is very much similar to that. The major difference is that you can select whether what is the type of entity, whether it's an individual, HUA, partnership firm, or LLP. If you select a partnership firm, you get one more additional sheet, that is a partner sheet. Here we can select what number of partner that we have in that partnership firm, whether we want fixed capital schedule or we do not want. Then we can fill the capital account movement over here. Other all the things like import from import data from Tally. If you don't have data in Tally, you can always use the Excel TB import option also. So this all things are very similar to the tool that I have shown to you just before now. So this thing can also be used for non-corporate entities as well. And by using this tool in your organization, the major benefit, as I said, that from year 2 onward you will get, and the biggest benefit is that all of your financial preparation as well as financial the presentation that you give to your client, that will get standardized across all your client. So this will be very useful thing. There is a as I said that this 2-3 tools are available. Let me show to you one output report also. And after that, we can open the session for question answer. This is the output report which has been generated from the tool. Balance sheet, P&L, cash flow. Yeah, so we can open the session for a question answer now.
Okay. Thank you, Vishal sir. The first question and the most important, can you please share this Excel tool?
Yeah, so here I would like to share one quote that the Mark Zuckerberg quote is that there is the no product is a free. If the product is free, then you are the product. So this is the paid utility. For more detail, you can visit on the website, that is a www.blackhorseexcellence.com. Even we have shared the number also. Whoever members are interested, we provide a trial version also. They can use the trial version and then they can decide on further.
Okay. The next question is, tool is compatible with which ERPs? Is customization possible?
This tool is compatible on Tele ERP 9, Tele Prime, even Tele Prime 3.0. With that, it is compatible. The settings which is required is very general. That is even explained in the tool itself. Simply, if you click on this thing, integration is with the ODBC facility which is given by the tool. There is no any extra technical requirement is being required.
Okay. Is customization also possible?
Customization, yeah, user can always share their feedback. We always upgrade the tool based on the client's feedback. If it is doable, in general we do, but one special customization we don't.
Okay. Okay. So the next is how to add audit JVs in the tool.
Yeah. All right. So this is the good question. The audit JVs can directly be added in the TB sheet itself. Let me show it to you. Let us the standard example of audit JV is that tax provision. Let me tax provision JV. We can directly enter over here. Audit JV. In the trial balance itself, directly at the bottom, you can enter that income tax provision current tax. So let's say I'm crediting 5 lakhs rupees and I'm debiting 5 lakhs rupees. So whatever the credit that I have done, that I can group under the short-term provision. Under that, it can further be grouped under the provision for income tax. And the debit that we have did, that we can grouped under the tax expense, and under that also this can be further grouped under the tax expense. So this is how audit JVs can be passed. And further, this tool is having the facility of computation of tax. Here we can do a computation of tax, then there is a depreciation as per the income tax can be calculated, and deferred tax calculation can also be done in this.
Okay. The next question is, do you have separate tool for Ind AS financials?
Yes, we do have a separate tool for Ind-AS automation tool, that is separate. The members can contact us. We will be personally demonstrating that thing to them.
Okay. Whether updation is provided for regulatory amendments?
Yes, we do. So just to give you a background of the tool, this we have been developing from last 5 years. This is the 11th version that we have released. And whenever the lastly released in the August itself. So whenever we release the updated version, you get the new version, new Excel itself, and whatever work the client has already done in their previous version, that can be migrated using this. So whatever work you have done in the previous Excel, that will not go away, that can be migrated in the newer version also. It doesn't mean that you will have to redo the work.
Okay. Whether audit report is also integrated?
This tool contains the financial reporting starting from the balance sheet. So as of now, audit report is not being included.
Okay. What if the client has data in SAP and not in Tally?
Yeah, if they don't have data in Tally, that is all fine. There is option given in the tool, Excel TB import. Let me show it to you that. Excel TB import. So if you click on that, it will take you another sheet. Here we can simply copy the trial balance. If they have a trial balance, whichever is the accounting software the clients are having, we can always get the uh, trial balance in Excel. That trial balance can be simply copied over here, and then we can just click on import to TB. So that trial balance will get imported into this main sheet.
Okay, sir. So there are no further questions. So moving to vote of thanks. It was a privilege. It is a privilege and pleasure to extend a heartfelt gratitude to our today's speaker, CA Vishal Mulchandani, for the insightful speech on Excel automation for financial reporting. Excel is something which we professionals use very regularly for our work, and learning about such automation techniques would greatly help us in doing our work more efficiently and effectively. The Excel automation tools you introduced will undoubtedly enhance our efficiency and effectiveness in handling the data and the tasks within Excel. Your explanations were clear and your examples were very practical, making it easy for us to grasp and implement these tools in our work. We are excited to put this new acquired knowledge into practice and see the positive impact it will have in our work processes. We once again thank you for your time and dedication to help us excel in Excel. We look forward to your future opportunities to learn from you. Thank you.
Yeah, thank you. Thank you very much to the committee, all the committee members and chairman and chairperson and the co-chairperson who has given us an opportunity to showcase the automation tool. And thank you all the participants who has joined the session and listened us carefully. Thank you very much for that time.
Thank you.